Hi. Let's learn about the key rate today. The key rate is the specific interest rate that determines bank lending rates and the cost of credit for borrowers. The key rate is the specific interest rate that determines bank lending rates and the cost of credit for borrowers. In the U.S., the two key interest rates are the discount rate and the federal funds rate, which are set by the Federal Reserve to influence lending and the supply of money and credit in the economy. The key rate is the interest rate at which banks can borrow when they fall short of their required reserves. They may borrow from other banks or directly from the Federal Reserve. The rate that banks can borrow from other banks at is called the federal funds rate, while the rate banks borrow from the Federal Reserve at is called the discount rate. When a large percentage of account holders withdraw their funds from a bank, the bank may face liquidity issues. This is because of the fractional reserve banking system, which requires banks to keep only a small percentage of their deposits in cash. Key rates are the chief tools used by the Federal Reserve to implement monetary policy. When the Federal Reserve wants to expand the money supply, it will typically buy bonds on the open market and use the federal funds rate to gauge the volume and speed of bond purchases needed. On the other hand, when the Federal Reserve is in a contractionary phase, it will raise the rates to increase the cost of borrowing, controlling the money supply and affecting the national economy. The federal funds rate is the rate that banks charge each other on loans used to meet their reserve requirements, governing the overnight lending of funds made available to private sector banks. Banks also have the option to borrow directly from the Federal Reserve at the discount rate, which is set by the Federal Reserve. If the discount rate is increased, banks are reluctant to borrow, leading to a decrease in lending. Here are 3 key takeaways. 1. The key rate determines lending rates for banks and the cost of credit for borrowers. 2. There are 2 types of key rates, the discount rate and the federal funds rate. 3. The Federal Reserve can influence the rate at which banks can borrow money to expand or contract the national economy. Hope this would help. Thanks for watching.